Most people go their whole lives not really understanding money, not because it's hard, because nobody ever explained it in plain language. Credit, debit, loans, mortgages, interest. It sounds like a whole different language. So I gave myself one weekend to actually understand all of it using only free AI tools. And by the end, I understood banking better than I did after years of just using a bank. And here's exactly how. So here's the trap. Banks profit when you don't understand banking. Every confusion term, every fee you don't see coming, every minimum balance, that confusion has a price and you have to pay it. The average person loses real money every year simply because they never learned how the system works. The good news? You don't need a finance degree. You need someone to explain it like you are smart but new. And that's exactly the one thing AI is genuinely good at. So I'm going to walk you through the 5 things that unlock 90% of banking and show you how to use free AI to go deeper on any of them. Concept number 1, debit versus credit. Start with the one everyone thinks they know. Debit is your money. Credit is the bank's money that you're borrowing and promising to pay back. That's the whole difference, and it changes everything downstream. When you use debit, the money leaves your account instantly. You can't spend what you don't have. When you use credit, you are taking a short term loan every single time, and if you don't pay it back in full, they charge you interest. Now, here's the AI trick. Ask a free AI assistant like ChatGPT or Claude to explain the difference. Concept number 2, interest. Interest is the single most important word in money, and almost nobody has it explained properly. Interest is just the price of time. When you borrow, you pay interest, the cost of using money now instead of later. When you save, you earn interest, the bank paying you for letting them use your money. Same idea, opposite direction. And there's a multiplier hiding inside it called the compound interest, which means interest that earns more interest. That's why small debts quietly become huge ones, and why small savings left alone for years quietly become large ones. Concept number 3, loans. A loan is just borrowing with rules attached. How much, for how long, and what interest rate. Every loan is only 3 numbers: the rate, the interest they charge, and the term, how long you have to pay it back. Change any one of those, and the whole cost changes. A longer term feels easier because the monthly payment is smaller, but you pay far more interest overall. That trade off is where most people lose money without realizing it. Here, use AI to run the comparison before you ever sign anything. Give it the 3 numbers and ask it to show you the total cost over the full term. Concept number 4, mortgage. A mortgage sounds like its own scary thing. It's not. It's just a very big loan secured against your house. Now, secured is the key word. It means if you stop paying, the bank can take the house. That's why mortgage interest rates are lower than credit cards. The bank is taking less risk, so they charge you less. Same principle as before, principal, rate, and term, just bigger numbers and a longer clock, often 20 or 30 years. And over 30 years, compound interest does something wild. You often pay nearly double the price of the house. Ask AI to show you that exact breakdown for a realistic number in your country. Once you've seen it, you'll understand every should I pay extra on my mortgage debate instantly. Concept number 5, the one that ties it together. Now, here's the concept that connects all of it, which is risk. Every single thing a bank does is priced on risk. Lower risk to the bank means lower interest for you. That's why a mortgage is cheaper than a credit card, why a good credit score gets you better rates, why saving account pays so little. You are taking almost no risk, so you earn almost nothing. Once you see banking as a giant risk pricing machine, the whole thing stops feeling random. Every fee and rate suddenly has a reason. Here's the honest part, because AI isn't magic here. AI will explain concepts brilliantly, but it can get specific numbers wrong, and it doesn't know your country's exact rules, taxes, or current rates. So use it to understand and verify anything that involves a real decision with a real source or a real human advisor. The goal isn't to replace expert advice, it's to walk into that conversation already understanding the language so nobody can confuse you into a bad decision. So that's banking: debit versus credit, interest as the price of time, loans as three numbers, mortgages as big secured loans, and risk as the thing pricing all of it. You don't need a course, you need plan explanations and a free AI tool willing to give you 100 examples until it clicks. That's a weekend, and understanding this stuff pays you back for the rest of your life. See you in the next one.